What follows next might just be the game changer in your investing journey. So, let's get started on today's fascinating topic, the second act of our financial statement trilogy, the cash flow statement. What is a cash flow statement, you ask? Think of it as the company's financial diary, a record of cash coming in and going out. Why is it so important? Simply put, it's because cash is king. A business can show impressive profits, but quickly find itself in hot water if it's not generating cash. To understand a company's cash flow, we must delve into three main components: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now, to make things even more exciting and tangible, let's use a real-life example as we decode these categories and look at the numbers of the well-known tech giant, Apple. The first component, cash flow from operating activities, reveals how much cash the company's core business operations generate. You'll notice that the first line in that section is net income, which is calculated on the income statement. Remember to check our previous video on how to assess an income statement, like an investment analyst, for a detailed and insightful rundown. After starting with net income, we add back non-cash items like depreciation, amortization, and share-based compensation. Why add them back? Because these expenses decrease net income on the income statement but don't actually result in a cash outflow. Depreciation and amortization are accounting methods used to allocate the cost of long-term assets, like machinery, equipment, buildings, patents, and trademarks, over their useful lives. Depreciation and amortization merely spread out the cost of assets over time, rather than accounting for the entire cost in the year the asset was purchased. As for share-based compensation, it is a method companies use to reward employees or executives by offering them a chance to buy company shares at a discounted price, or even gifting them shares as part of their compensation package. But just like depreciation and amortization, they do not result in a direct cash outflow for the company. At least not immediately. In the case of Apple, share-based compensation expenses amounted to more than $9 billion during its 2022 fiscal year. Next, we consider changes in operating assets and liabilities, or what's often referred to as changes in working capital. These include accounts receivable, inventory, accounts payable, and accrued expenses. In essence, it shows how changes in balance sheet items impact cash flow. Add them all up, and we arrive at the net cash generated by operating activities. This is a crucial metric as it shows how much cash the company's core business is actually producing. The next stop on our cash flow statement journey takes us to the cash flow from investing activities. This is where companies report the cash spent on growth and expansion initiatives. In this section, we'll often see purchases of investments and the cash received from selling those investments. This is quite common for cash-rich companies like Apple, who would rather see their money work for them in investments than sit idle in a bank account. Another critical item you'll spot here is cash used in business acquisitions. It's not uncommon for businesses to accelerate their growth by buying other companies. This could be to gain a foothold in a new market, add a new product line, or even acquire a competitive edge. And now, for the real star of this section, capital expenditures, or CapEx. CapEx is the money that a company uses to buy, maintain, or improve its physical assets, like property, plant, or equipment. These investments are crucial for a company's growth and sustainability. Imagine a tech company like Apple not investing in new equipment, technologies, or facilities. Over time, its innovation would stagnate, its products would become outdated, and the company would fall behind its competitors. Scary, right? Finding CapEx in the cash flow statement might require some detective work, as it might not be explicitly labeled capital expenditures. Instead, it might appear under the less glamorous title of payments to acquire property, plant, and equipment, or something similar. Before moving on, let's pause and discuss a key metric savvy investors love: free cash flow. It represents the cash a company generates from its core operations, minus its capital expenditures. In layman's term, it's the cash left in the bank after the company has done all the necessary spending to maintain or expand its business. Free cash flow is like a financial health check. It tells you whether a company has the monetary muscle to innovate, grow, and most importantly, reward its shareholders. In the case of Apple, it generated an astonishing $111 billion in free cash flow in 2022 alone. You can then get the free cash flow yield by dividing free cash flow by the company's market capitalization. It's a lot like earnings yield, but some investment experts argue it's even more reliable because it's based on real cash, which is much harder to fudge than earnings. So why do investors care about the free cash flow yield? Well, it's a powerful tool to gauge if a company's shares are over or undervalued. A higher yield might indicate that a company is undervalued, offering a potential opportunity for savvy investors. And finally, we come to cash flow from financing activities. This involves cash coming in from issuing stocks or taking on debt, and cash going out to pay down debt, repurchase stock, or distribute dividends. Speaking of dividends, they often carry a powerful message to the market. Consistently increasing dividends are seen as a vote of confidence by the company in its future earning power. On the other hand, a decreasing or canceled dividend is usually seen as a cautionary signal to investors, suggesting the company might be preserving cash for financial stability or reinvestment. However, digging deeper and understanding the rationale behind such a decision is essential. Stock repurchases are another strategic move by companies to return cash to shareholders. It's like a company saying, "Hey, I believe in myself so much, I am buying back my own shares." This reduces the number of shares available in the market, boosting earnings per share. But beware, you must ensure the company's free cash flow can comfortably cover these buybacks. You see, the cash a company pays to its shareholders, whether as dividends or share buybacks, should ideally be less than its free cash flow. If it's consistently more, it can indicate the company is borrowing to keep the cash flowing to shareholders, which is clearly unsustainable in the long run. And despite returning $104 billion to its shareholders in 2022, Apple ensured it would not exceed the free cash flow it generated. So, there you have it, folks. The cash flow statement was decoded. As our financial saga unfolds, remember this: to really know a company, don't just focus on earnings. Look at the cash too, because at the end of the day, it's the cash that pays the bills, not profits. Remember to like, share, and subscribe if you found this content valuable. And as always, may your financial journey be rewarding.